Donald Trump just did something that could rewrite the rules of retirement in America. And depending on who you ask, it's either the most empowering financial reform in decades or one of the riskiest gambles ever made with ordinary people's money. For the first time in U.S. history, your retirement account, your 401, your IRA, the nest egg you've been told to protect carefully for decades, can now legally invest in cryptocurrencies like Bitcoin and Ethereum, and in private equity funds that have always been the playground of billionaires and giant institutions. Think about that for a moment. The same money you're relying on for your future stability could be tied to assets that sometimes crash 50% in a single year, or to investments that charge sky-high fees and lock your money away for years at a time. Does that sound like a step forward in financial freedom? Or a step backward into uncertainty and danger? Let's break down exactly what happened and why this is such a bombshell. Trump signed an executive order that essentially clears the way for retirement accounts to hold these riskier assets. And just as importantly, it shields employers and plan administrators from lawsuits if those options underperform or blow up. That's huge, because until now, most companies avoided adding things like crypto to retirement plans, out of fear they'd get sued if employees lost everything. Now, that legal barrier is gone, so the result is simple. You could very soon log into your retirement portal and see Bitcoin Fund or private equity opportunities sitting right next to your S&P 500 index fund. Sounds exciting, right? But here's the bigger question. Do more choices actually help average people? Or do they just create more opportunities for mistakes and exploitation? Let's start with crypto, because that's the part grabbing headlines. On the one hand, the upside is undeniable. Bitcoin went from basically worthless to tens of thousands of dollars per coin in a little over a decade. Ethereum built an entire ecosystem of decentralized apps and finance. Some early investors made life-changing fortunes. And if you believe in the future of crypto, having it inside your retirement account could be a way to capture that growth tax advantage. But here's the harsh reality. Crypto is insanely volatile. Bitcoin has crashed by more than 70% multiple times. Entire exchanges like FTX have collapsed, wiping out billions. Hackers have stolen billions more. And regulators in Washington still can't agree on who even oversees crypto. Should it be the SEC, the CFTC, or a brand new regulator entirely? Ask yourself this. If you opened your retirement statement one morning and saw your balance down by half because Bitcoin tanked, would you panic? Would you sell at the bottom? And most importantly, can your retirement plan handle that kind of roller coaster? This isn't play money, it's your future. Should it really be tied to an asset that can lose years of gains in a single bad month? Now let's shift to private equity, because it sounds safer, maybe even prestigious, but it comes with its own minefield of problems. Private equity firms pool money to buy companies that aren't on the stock market. Sometimes they scoop up promising startups, other times they buy struggling companies and try to turn them around. In theory, you're investing before these companies go public, getting in early on potential growth. But what's the catch? First, fees. Private equity is notorious for the 2 and 20 model. 2% of your investment every year in management fees, plus 20% of the profits on top. Compare that to a simple index fund that might cost you 0.05% annually. Would you willingly pay 40 times more in fees when there's no guarantee of better results? Second, transparency. Public companies file quarterly reports, disclose risks, and have stock prices you can track daily. Private equity firms? Much less disclosure, often highly complex structures, and you might not really know what's happening with your money. And third, liquidity. Once you're in, you're often locked in for years. Imagine needing cash or wanting to adjust your portfolio and being told, "Sorry, you'll have to wait 5 years." Does that sound like the kind of flexibility you want for your retirement? So why push this now? Supporters say it's about freedom and equality. They argue that for too long, only the ultra-rich have had access to these high-growth opportunities. Why should a school teacher or a factory worker be locked out of the same investments billionaires get richer from? Shouldn't everyone have the same chance? And let's be real, many Americans already invest in crypto personally. Bringing it into regulated retirement accounts could, in theory, make it safer and more mainstream. But critics fire back hard. They say this is classic deregulation, stripping away guardrails and shifting risk onto average workers who don't have the time, training, or resources to navigate such complicated products. If retirement accounts start pouring billions into crypto and private equity and the whole thing crashes, who's really left holding the bag? Is it the workers whose retirements vanish? The employers who offered the funds? Or taxpayers who might eventually bail out parts of the financial system? This debate goes deeper than just financial products. It's about trust, responsibility, and fairness. Can average Americans really evaluate whether a private equity fund is worth investing in when even professional investors sometimes get burned? Will crypto's volatility erode confidence in the retirement system itself? And here's a more personal question. Would you feel comfortable explaining to your spouse or your kids that your retirement account just lost half its value because you wanted to try Bitcoin? Or that you can't touch a chunk of your savings for 10 years because it's tied up in a private equity deal you don't really understand? Now, it's worth pointing out, not every private equity deal is bad, and not all crypto is doomed to fail. Some private equity funds have outperformed the stock market. Some crypto advocates believe digital assets are the future of money, and that this volatility is just part of the growing pains. But history gives us reason to be cautious. The dot-com bubble, the housing crash of 2008, the repeated crypto winters. These all show how hype can lure people in, only for reality to crash down hard. Isn't retirement supposed to be the one place where you don't have to gamble? And think about human behavior for a minute. It's one thing to say, I'll just put 5% of my portfolio into crypto, nothing crazy. But when markets soar, when you see headlines about Bitcoin hitting new highs or private equity making billion-dollar exits, how many people will resist the urge to pile in heavier? And when things crash as they always do, how many will sell at the bottom, locking in devastating losses? The temptation is real, and the average retirement saver isn't trained to manage it. Should our retirement system be built around willpower and speculation? Then there's the political angle. This move is being framed as empowerment, as giving people freedom to invest as they choose. But isn't there a difference between freedom and exposure? Between opportunity and risk? Critics say this isn't about empowering workers. It's about funneling trillions of dollars in retirement savings into the hands of Wall Street firms and crypto companies desperate for fresh capital. And remember, those firms get paid regardless of whether you make money. They collect fees no matter what. Does that sound like a system designed for your benefit or theirs? So what should you do if and when these options show up in your retirement plan? The safest answer is simple. Don't feel pressured. Just because something is offered doesn't mean it's good for you. Ask yourself, do I understand this investment? Do I know the risks, the fees, the restrictions? Am I willing to lose this money? Because if the answer is no, maybe the best move is to stick with what's worked for decades. Broad, low-cost index funds that grow steadily over time. They may not be flashy, but they've built more wealth for more people than crypto or private equity ever has. At the same time, if you really believe in the potential of crypto or private equity, you could dip your toe in, but only with a small slice, maybe 5% or less, and only if you're truly comfortable with the possibility of losing it. That way, you're not betting your entire future on an experiment. Because make no mistake, that's what this is, an experiment. We don't know how retirement accounts loaded with crypto and private equity will play out long term. Maybe it works brilliantly and creates new wealth for millions. Maybe it ends in a disaster that makes the 2008 crash look tame. Either way, you'll want to be very sure about your choices before your life savings are on the line. So here's the final question. Is Trump's move the dawn of a new era of financial freedom or the start of the riskiest retirement experiment America has ever seen? Is this your chance to finally play on the same field as billionaires, or just a clever way to make sure Wall Street and crypto firms get a new stream of money while workers carry the risk? At the end of the day, only time will tell. But now that the door is open, you have to decide. Will you step through it, or will you keep your retirement safe on the other side?